Yeah, I'm here with the wiser king of data, Andrew Pratt. And I wanted to get Andrew in on this episode because we're talking about national debt. And man, it keeps getting bigger. How big of a problem is it? I go back to this whole thing with Trump and Musk, and the bromance is over. And if you go back and listen to the All In podcast and you listen to the interview of how they recruited Musk to do what he did, the whole thing was he was supposed to be the guy to find $1 trillion worth of waste, and then they're going to get $1 trillion worth of tariffs.
Optimistic, yeah.
And then they're going to not tax anybody who made less than $150,000 a year. That's how they recruited him.
Right.
And then they were going to, have a balanced budget in the end, because that's about what the deficit was, around $2 trillion. And when the big beautiful bill came out, which is a little more costly. Well, it depends on who you talk to. If you talk to administration, they say the growth will solve the problem. There'll actually be a surplus.
I think that's a typical talking point from every administration.
Every administration says that. And then you look at other reports and it makes it worse. And so that's why he got upset. So I just go back to everyone here probably listening to the podcast understands how money works in their household.
Right.
And if your debt keeps getting bigger and bigger and bigger, and you don't have the income to service that debt, that becomes a problem. But at a national level where you control your currency, things are a little different. You can still create problems, right?
Yeah.
So let's go back to what is national debt? How do we get here? And what do you see in the data that you look at every week?
Yeah. I think, it's important maybe just to kind of take a step further back and just talk about, this is if you look at a balance sheet from the US perspective as a country, as a nation, what does your balance sheet have as assets and liabilities? So, from an asset standpoint, that can mean anything from, the gold reserve and land investments, military equipment,
Mount Rushmore.
Yep. Even student loan obligations,
right.
Which, hopefully those get paid back.
Right.
Those are assets. On the liability side, it's primarily composed of the national debt. And that really includes, they'll issue treasury securities, and it's really obligations that are owed to domestic and foreign investors. And it also includes unfunded obligations or, obligations to entitlement programs like Social Security, and just in, future obligations like Medicare and other entitlement programs. So if you just take, going back to the balance sheet aspect of it, right now, the liabilities farly outweigh the assets. And so we have a negative net worth. There's a lot of different data out there, but from what, everything
that's hard for me to believe that the US has a negative net worth.
Well, so how this is presented. Yeah. I mean, you could talk about GDP and other total global influence, but from just based on the liabilities and the assets. Yeah, I agree. It's probably messaging wise. It's probably not.
Does that count the oil under the ground that hasn't been pulled out yet? Probably not, right?
Yeah, you're exactly right. I mean, so it probably could be framed better, but just based on those two components, the assets and liabilities, maybe we should just say, national debt. It's right now outweighs the assets by 33 trillion.
Wow.
So it's about the debt's about 37 trillion. The assets, give or take, are about 4 to 5 trillion. So that's where we stand right now. So I think really it's, not to keep kicking the can down the road. I think it's a problem I'm, concerned about, and it's something that needs to be looked at with caution. But, for real life implications, I think, it's really still 5 to 10 years away, or even maybe longer, to where it has severe impacts and, to our future generations. But it's obviously a problem that Congress needs to get serious about on both sides of the aisle. And, every administration has policies and they talk about it, but they also want to see their agenda to fruition, and they keep issuing more debt, and there's larger deficits. So it's a serious problem that needs to be addressed sooner than later. But as far as like real life implications, the next 5 to 10 years, I don't think it's really going to impact us. But we can see there are some impacts already. Like longer term treasury yields are rising a little bit because I think um, global markets are saying, all right, well, there's a little bit more risk here, and um, the yields are indicating that risk. So it is kind of getting priced in some of the data.
So when you think about, uh, you have the national debt, but then what gets added to the debt is your spending. So
Right.
we're spending how much per year right now? More than we should.
Yeah. So right now, and there's actually a good chart that we have in here that shows like the fiscal deficits
Yeah.
since 2000, and we actually really haven't had a surplus, I believe, since it's 2001. So we've basically had a deficit
25 years.
Yeah, for that time frame. So it is, I hate to say normal, but it is typical in the past 25 years to have a deficit. The problem is these deficits are kind of growing, and there's no mitigation there. And just kind of for a frame of reference, there's been larger deficits in distressed years, like in 2009, coming out of the great financial crisis. There was a deficit of about 10%. Coming out of COVID, there was a deficit of 15%. Last year was 6.7. The CBO, or Congressional Budget Office, which is a unaffiliated third party that provides economic data to Congress, they're anticipating a deficit on average of 6.3% over the next 30 years. But yes, as you said, the deficits are financed by borrowing, issuing more treasury securities, and that is added to the national debt. So obviously, outside of the increase in debt, the issue is we have to pay interest on these debt obligations. And right now we're at higher interest rates, and that's more interest that is owed versus money that could be used to spur more economic growth. So that is an issue. But so I think obviously, where does this leave us? The administration has come out that they are, from on the surface, taking this seriously, and I guess we have 3.5 years to see what actually happens, but that they do have a few arrows in their quiver that they're trying to mitigate this risk. And I'll provide kind of the more I'll say optimistic perspective from their expectations, and then a little bit more counter to that with the CBO's estimates. And so the recent bill passage, the one big beautiful bill, kind of a mouthful to say, based on that, the administration expects about 1.4 trillion net, and in spending cuts. That's gonna be, the net is offset by a few expenditures.
That's defense. What the administration says. Yes. Third parties almost have the polar opposite of that.
Yeah. So the CBO is actually, they think it's going to be, well, I guess kind of jumping down a little bit. So in total, the administration thinks it's going to add 3% to GDP growth annually. Right. The CBO thinks it's going to be about half that, like 1.8%. But the administration believes this will also lead to about 760 billion in a reduction in the deficit. The CBO thinks that's not going to happen at all. They think, because based on the tax cuts, which there was the extension of the TCJA, the Tax Cuts and Jobs Act, that really won't provide a tailwind necessarily, but I think it just gives more corporations and kind of more transparency to them about like, hey, tax rates are going to remain at this level for foreseeable future. But there are some other tax related matters where this should, hopefully spur economic growth, like with no tax on tips, no tax on overtime, etc. But the CBO thinks that the reduction in new tax policies, they think that the lost revenue from that is not lead to a deficit reduction, basically. So they are more conservative in their guidance on that. But real quickly, just I guess a few more other kind of arrows in the quiver of the administration is they think revenues will help offset the deficit. They're expecting 2.8 trillion in the next 10 years. CBO is no comment on that. The discretionary spending, they think, the recent bill passage, and some other reductions there, and DOGE, Department of Government Efficiency, additional kind of review might lead to about 7 trillion in deficit reduction. CBO thinks about 1 trillion there. And I think one other thing is, I haven't really seen a lot of news about this lately, but the Trump gold cards, which kind of like vanished from the news, I feel like. But the last thing I saw is there was about 70,000 applicants for these 5 million cards. I think it's about 350 billion. Wow. So hopefully that will help.
70,000 applicants are willing to pay $5 million for U.S. citizenship.
That's the latest
Holy
statistic
crap.
I've seen.
I did not know that.
Yeah. So
okay.
I guess we'll see where that lands. But right. if they are able to use that money responsibly and help, direct that toward the deficit, that could be another, way that we could help reduce this.
Yeah. Okay. How does that work? Real quickly before we transition here, how does that affect you in managing portfolios when you see all this building? Because you said it's a 5 to 10 year problem, but at some point that gets closer, right?
Yeah, definitely. I mean, I think again, obviously, keep a pulse on what's happening with policy and the budget, and as long as I guess more so on the fixed income side, obviously interest rates are kind of indicating that. So just being well positioned to not have too much exposure on the longer side, longer duration and fixed income. Equity side, corporations could be hurt a little bit from, basically just like the spur of, not as much growth incentives here in the U.S. domestically. Mm-hmm. So it's just something, as far as like adjusting allocations from international to domestic, but again, right now, I still believe that domestic is better positioned in the long term to outperform international markets for various reasons. But again, it's just something to kind of, it's always evolving and changing. You just got to kind of have to keep up to date on.
So there's no emergency now.
No,
you have to have your pulse on what's happening.
Yeah, exactly. And we'll see the next 3.5 years or so how these policies play out.
Yeah. All right. Thank you very much, Andrew. Welcome to a Wiser Retirement Podcast. Are you curious about how America's national debt works? I'm Casey Smith. Today, I'm joined with Shauna Theriault. Each week, we bring you practical advice on retirement, investing, and planning for your financial future. Don't forget to subscribe to our podcast wherever you're listening. Let's get started. Hey, Shauna.
Hi.
Have you recovered from our outing?
Yes. I didn't really work that hard.
We get forced into team
building. It's not forced.
Team building.
It's good for the company.
And
the teammates.
Marketing manager here, Hadley's in charge of finding something that we can all do together. We went, I don't even call it bowling. It was like, it's down at the Brave Stadium. It's a punch bowl social, and they have some bowling lanes, but the pins are held by string.
Okay.
It's kind of like if you went a bowling alley in your house, I feel like this is what it would look like. But I mean, it's a nice hangout place.
It's fun to hang out there.
It's fun to hang out. Fun. But we Shauna was like throwing down strikes over here.
It was because the strings, it was messing me up.
The strings. It was definitely the strings.
No, it was bad.
People would
I'm not good at bowling.
People would clearly bowl a strike or get a spare, and machine wouldn't count it.
Like I wanted to make you feel good.
Is that what it is?
I didn't want to overshadow your high score.
I think I did okay, considering our lane would never give you a strike or a spare.
That's the only reason we did so bad. It was because of that. It was the technology.
The max you could get at any bowl was 9.
I know. And one time I actually did hit 9 pins down, and it only did 8.
It only said 8.
Yeah, exactly.
It just subtracted 1.
That was the one time I hit 9 pins.
It was funny, as we've done this before. It was like 2 years ago. We went to the exact same location, and the exact same problem happened. And so when Hadley asked me, should we go back? And I was like, well, yeah, that sounds fine. I'm sure they fixed the machines by now. It's been 2 years. No.
That's how they make it fair for everybody. Everything doesn't work.
They just give you random numbers. Just give you random numbers.
So that way no one looks bad. It's just fun.
It's pretty bad.
Guess they can't have bowling leagues there, though.
No, definitely not. Oh my gosh. No. You'd have people like swinging punches at each other.
Well, then maybe that's why it's called punch bowl.
Cha-ching. All right.
But this is not a laughing matter.
This is not a laughing matter.
The deficit is not.
I feel like we should have a bugle playing or something.
I know. If our client's balance sheet looked like this, we would be very concerned. We would say you cannot retire.
Yeah. I mean, I was just talking to Andrew before you came on, and that's kind of what I opened it up with was individuals. If you ran your household like this, I mean, every household has some sort of debt.
Right.
But if you have a ton of debt, as long as you have the income to support it, then you're going to be okay. You just got to do some things differently.
Right.
Where if we ran it like the government did it, I mean, we've had a deficit. There's a chart here.
24 years.
Sorry if you're having to hear my pages ruffle here, but yeah, 24 years. We had a $130 billion surplus in 2001. And every year since then, it's all over the place. Obviously, COVID year was $3.13 trillion deficit.
I mean, they were outflowing a ton of
$2.77 trillion
cash flow that year, though.
2009, 10, 11 were really bad years, obviously. So anyway, the deficit really converts into debt. And then how does that relate to us as investors, right? So we carry one of the largest debts in the world. Yeah. And what does that mean? Does it, I mean, how does it affect us as citizens? How does it affect us as investors? I guess to be clear, national debt is how much money the federal government owes to its creditors.
Right.
So it's made up of publicly held debt. That's treasury bonds, securities sold to individuals, institutions, foreign governments, the Federal Reserve. Then there's intra-government holdings, money that the government owes itself, mainly from borrowing from trust funds like Social Security and Medicare.
Well, and that's the questions we get all the time. It's like, okay, so they hear all this and, get into hear these things. And it's like, what's going to happen to Social Security? That's the questions we get all the time.
So how much do you think our debt is right now? Have you looked at it? Have you looked that far?
I have.
Oh, dang it. Never mind. Yeah. We'll ask the listeners, how much debt do you think there is right now? Guess a number. And
it's a lot.
And the answer right now is $36.7 trillion and rapidly rising. That's 121%, 123% of the gross domestic product of the country, which is the insane.
Income. Right.
Yeah, that's kind of like your debt to income ratio.
Exactly.
So would you, if you walked into the bank with 123% debt to income ratio, would you get a loan for a mortgage?
Not. Of course not.
Would they even give you a loan?
No, your credit score would be bad.
0? Negative?
Negative. Exactly. It would not be good at all. Definitely. Well, and I guess, that's where, how does it affect Americans? How does it affect everyone? I mean, that's the question. And it's like they keep kicking the can. There's a bunch of debt that's maturing this year. And, that means they're going to have to refinance it. If rates are higher, it's going to be at a higher rate. So,
Yeah, and that's why you're seeing Trump really
push the rates down.
Banter with the Fed chair, because even a rate was if the rate drops by 1%, how much in billions of dollars in interest payments that saves us.
Right. Exactly.
It's a big deal.
It is a big deal. Because they have to be able to. And I really think, we've talked about that for years. With interest rates being as low as they were after 08 and 09, they've obviously crept back up and they had to, come back up. But that's been the biggest thing. It's like because of the debt, they kept it almost artificially low for so long, which hurt, pensions, other things that could only be in like fixed income insurance companies, all those things, individuals that were retired, all those things where we liked the mortgage rates. But it kept it artificially low for a really long time for multiple reasons. But one of the things that was always talked about was because of the debt and us having to service the debt as a nation.
Yeah.
So now things are going to be maturing this year and they're faced with it again because the payments are going to go up so much.
Yeah. I mean, how do we even get here? Obviously, we see the deficits every year, but what is the deficit on? Really, a lot of it is 2008. There's a lot of
financial crisis. Oh, of course.
A lot of stimulus during that time period. We talked about COVID already.
Yeah.
But you also have entitlement programs, which Social Security, Medicare, Medicaid, those are all big expenses.
They are.
Not that anyone should be saying get rid of those necessarily.
Well, in all fairness, it's a big expenses, but people have paid into those things. Well, as far as Medicare, obviously Social Security, right? But people are living longer, than they were in years past, and fluctuations in the workforce.
Corporate tax cuts being slashed back in 2017. That adds to the deficit. Although I would argue that the big corporations, they don't pay, corporations don't pay their fair share.
You're talking about C corps,
like big, Coca-Cola's, the GEs, right?
Yeah.
They don't pay as much taxes as you think because they have the resources and land credits and things like that. The people who pay the business taxes are people like me,
small business owners.
I'm paying my fair share, buddy.
Right. Exactly.
But yeah, the tax policy changes. That's another thing too. Andrew mentioned earlier, talk about the balance sheet of the country. People don't think like that. People don't think in terms of assets and liabilities. Like most households, you say, what is your net worth? And a lot of people got net worth means.
Right.
But yeah, he said, he was stating that there's a negative net worth to the country. I disagree with that. I think if you counted the natural resources of this country
as an asset, we have more than enough resources to cover debts. We'd have to remove a lot of protections off those assets in order to pay for them. Yeah.
But I could be totally wrong. I don't have any data to support that, but I think when accounting, you count things a little differently than what reality is. Right.
Mm-hmm.
So we're probably getting the liabilities correct. That's very easy to see. But the
actual assets,
assets would be very different ways to count that. But that's just my opinion.
Really, if you think about it, is that something that they would tap or could tap if and there is, and that's, I think, most of us, I don't want to say we don't worry. It's not that we don't worry, but the power of taxation, they've always had the power of taxation, which hurts the economy further. But that's where it's like, well, they could always tax more or change how they're doing things. And the whole Social Security thing, that's like such a huge subject. People are living longer, but people also are working longer. So they're paying longer in, right?
Correct.
So sometimes that doesn't make sense to me either. And there's more people I know there's more people collecting and there's people living longer, but there's also more people working and they're working longer than they used to, I feel.
We're working longer, but there's so many baby boomers and we haven't had as many the birth rates really dropped, right?
True.
So I think that's why we're seeing the difference there. We spend $1 trillion annually on interest. So if you think if you're working someone's personal life, one of the easiest ways I show them why paying off debt is so important is, hey, if you're paying $5,000 in all your debts to total, not including maybe your house,
right?
We eliminate this, that frees up $5,000 a month in cash flow,
right?
And
that you can invest or spend or
exactly. So you think about the U.S. government being debt free is probably not realistic, but if we're spending $1 trillion annually on interest,
just wasted money.
Yeah. Actually, no one remembers this during the first Trump administration when he was being impeached the first time. His administration tried to push for refinancing all U.S. debts at that time. Because remember, interest rates are really, really low because of COVID.
Right.
So the U.S. government would have had nearly 0% interest. And he was trying to do $100 million or $100-year bond. Mm-hmm. And imagine if that had actually gone through. They were so focused on impeaching him that some people thought he'd be leaving office soon, which it's kind of hard for that to happen, no matter who's being impeached based on history, right?
Right.
But if that could have happened, we'd be such a different position right now. What are the risks if we keep doing this? Andrew didn't quite get to these, but this is things we've talked about in the past. If we can't service, if the U.S. government can't service its debt, you're going to end up having higher interest rates. Mm-hmm. You're going to have, there's this phenomenon called crowding out, that's where government borrowing money may limit private investment. So there's just so much government money out there that people can get guaranteed rate of return on at a higher interest rate,
right?
That then they won't invest as much in the private sector, which would hurt the economy. obviously reduced fiscal flexibility. So imagine if you had a COVID and you dealt with all that, and then you had the financial crisis within 2 years later.
Oh,
like that would be pretty detrimental.
Definitely. You're not
to the
prepared
economy.
right.
And then obviously inflation. If you print too much debt, you're going to end up with too much. You have like a Brazil or a Venezuela kind of situation with rapid inflation. It may look what happened in 21 and 22 like it was no big deal.
Before we get back into the episode, have you ever wondered why annuities keep coming up as a recommended investment? While they're often pitched as a way to reduce risk and secure your future, annuities frequently benefit the salesperson more than the investor. Download our free guide, Buyer Beware, Why Do They Keep Trying to Sell You That Annuity, at wiserinvestor.com/guides. Now let's get back to the episode.
So what if the government can't pay its debt? Can the government even default on its debt? So technically, as the U.S. government, it's a sovereign currency issuer. So it creates its own currency. It'd be really hard for it to, it can theoretically default, but it'd be really hard for it to default on its own debt. Like you and I we pay in dollars for things.
Mm-hmm.
We don't change the value of the dollar. We can't change the value of the dollar of ourselves. Right. If you're in Europe and you're Greece or you're Germany, two polar sides of the economic spectrum in Europe, Greece wants a really weak euro to help pay its debt. Germany needs a really strong euro to support its economy. So in that case, neither one controls the euro. But being that we can control our own currency, even the Chinese currency is backed by U.S. currency in the end. So it makes it really hard. It makes it really hard to default. Now you do have some roadblocks though. So you have a legal debt ceiling, and that's become very politicized over the years. It's happened since the beginning of time. You need to borrow more money. Congress has to approve borrowing more money. Right. So,
but then they just raise it.
You could have political,
yes,
you could have political gridlock over that. But in the end, they shut down the government for a few weeks, but they end up paying their bills. Right.
Right.
We talked about it a second ago. Inflation risk could be a problem. But I think probably the biggest one is confidence as a reserve currency status. So if we don't pay our bills on time and we create all this political mess around it, then you're asking for another currency potentially to come in to be the world currency. So obviously, if you had a technical default, so you miss interest payments, the government shuts down, your credit gets downgraded. This has all happened already, right?
Right.
You get stock market volatility around it, higher borrowing costs. That all happens in the short term. Long-term solutions to all this. So how do we fix some of this? You have to grow the economy faster than debt. So if we relate that to personal finance, you would have to grow your income faster than the interest payments that you're accruing.
Mm-hmm.
So you grow yourself out of the problem, which that's why every political cycle we're talking about growing the economy. How do we grow the economy? Right. That's how you make it. If you had $5 in revenue, but you had $2 going out in interest payments, but now you can have $10 in revenue and maybe only $3 or $4 going to interest payments, then you're in a better position.
Right.
So that's what all that's about. Reduce spending. That's kind of a big deal. I don't see that happening.
No.
I mean, we just did it, but then we passed another bill that potentially could add more to that.
Spending. Right.
We could raise taxes. Consumption tax. I mean, that's been tossed around.
Yeah.
You could inflate the debt away. So basically allow modest inflation to reduce the real burden of the debt. But if you lose, obviously you lose purchasing power at the same time. So that doesn't really help lower income citizens or hurts the poor people basically.
Right.
And we could also do debt restructuring. That would be detrimental to the U.S. Other countries, Italy did that during the financial crisis.
Mm-hmm.
Greece did that. If the U.S. did that, you'd almost think you would definitely lose your world your world domination as far as currency goes. So I kind of went down another rabbit hole from that. And I said, well, if we can just print more money to cover what this costs, and as long as we print it responsibly, does it even matter? Like, maybe none of this even matters if we just keep kicking the can down the road. And as long as we do it in a conservative manner, then it doesn't matter. So that's when I just stumbled upon this. That's when I stumbled upon modern monetary theory, MMT. Have you heard of this?
I have heard of that. I don't know the details of it, but I have heard it.
So I had not heard of it. But like I said, I went down this rabbit hole. So modern monetary theory says that deficits don't matter as long as inflation is under control. So government should spend to achieve full employment and use taxes to control inflation, but not to fund spending. That's the whole theory behind it. But even modern monetary theory thinkers acknowledge that inflation is the ultimate constraint. Once it rises, the government must tax or cut spending, which is awfully politically painful. Mainstream economists, like all of our former Fed chairs, they largely reject modern monetary theory as a real policy. But there are people out there in the government that believe that you can just keep doing everything you want to do, and as long as you
have the cash flow,
as long as you don't break it,
right,
with inflation, then you're going to be okay. And I would say that, okay, well, maybe Fed chairs don't necessarily agree with that, but Congress sure does, because I'm looking at the U.S. fiscal deficit from 2001 to 2025.
And that's the way it's been.
And that's exactly what's happening.
Right.
It's exactly what's happening.
Right.
So I don't know. I mean, is there really a problem? I mean, the short term, yes. Or short term, no, because the government's not going to go broke overnight. We could create serious inflation. You could have, maybe you don't have a technical bankruptcy, but you could still have tons of money to pay interest, being an issue. I think really weak economic growth is a problem. And if you have a lot of inflation, you're going to have social instability. So you think, during COVID, I saw firsthand the haves and the haves not. I saw it get spread really wide, really fast. And that's exactly what would happen if you're not handling your monetary policy correctly.
It would look like this.
Your middle class somewhere along the way would get split, and some families are going to get way worse, and then some families would move up with the higher wage earners.
This is so interesting because this is like right after the .coms that all of this started.
Yeah,
well, there was 1999 and 2000.
There were deficits though during the Clinton administration, but what people don't realize is Republicans and Democrats at the time worked really, really hard to balance a budget. They worked together to balance a budget.
Mm-hmm.
They did a lot. They sounded a lot like how Trump sounded. They stood out there in the White House lawn. They had there's videos. You can find this on YouTube, but there's really the TVs have come a long way in 25 years. But it's kind of grainy coverage, because he had tube TVs back then. But they had Bill Clinton and Al Gore, and you had I think Newt Gingrich. They're all standing out there with these folders, saying, "Oh, this is wasteful programs." And they're like throwing away folders and stuff. So there was a time period when both parties understood the importance of this, and somewhere along the way, it's gotten forgotten. Sure.
Yeah.
So I don't know. I mean, I think the sense that at least
there's other ways they can create tax though. Cause I really think like when you're looking at this chart, if you're looking at this online, 2008 and 2009, that is the financial crisis. And then what did they do? They said, okay, we're going to lift the income restriction of people over 100,000. You can now convert to Roths. And a bunch of people did it and they let you spread it over 2 years. Boom.
Right.
That just created taxation and created income during that times when that deficit was higher. I don't know if it's linked and if that's the reason, but it created income. But then also, what did they do during, they changed required minimum distributions coming out 2019, right before COVID. So they changed that. They retroacted that. And so they made it so now you could not spread distributions over your lifetime. You had to take it within 10 years. Well, that generates more income right there.
Yeah.
So they come up with, and for a little while, they talked about anybody with more than 5 million in any retirement account is going to have to distribute that. I think it was 5 million. I'm pretty sure about that.
Yeah.
They were going to have to distribute it out of the account and pay tax on it and lower the balances, no matter where you were working.
That went away. That was,
it did. It never went through.
They were targeting one person with that.
Okay.
There was a,
but there's still fancy ways that you can create taxes without just saying, we're going to raise the tax rates on everybody. You can come up with things like that are still increasing taxes during those years, but it's not affecting everyone.
Correct.
Or it's optional to take advantage of something.
Yeah.
Or the Roth in general. Everybody's paying more tax if you're doing a Roth. I mean, I feel like they come up with these things.
But that's not going to be trillions of dollars worth.
No, it's not.
It would take massive change in order to do that.
Fair.
That's partially where it's very controversial, but tariffs, obviously U.S. aid going away and all the crazy things that we read about through those articles. These are all things that they're trying to do. I was hoping that the one big beautiful bill was going to even further that along. I just don't see a whole lot of rhetoric out of the administration right now that says anything about we're going to balance this budget. And this is why. And I think it's because the reality is that in the next 5 or 10 years, it doesn't really matter that much to us as individuals. It's a long-term problem.
Yeah.
But it takes short-term action to solve the long-term problem. When the big problem gets here in 10, 15 years, whenever it hits,
it's going to be,
there's nothing you're going to be able to do about it at that time. It'll be too bad. It'll just be too bad of a problem. I'm not a negative person. I'm a positive person. I think that efficiencies through AI would allow companies to be more profitable, which creates more tax. I think there's a lot of things with innovation. So if you look at how we've innovated tech wise, we are accelerating at a faster pace than ever. So I feel that just like when the internet came on, right? And we got rid of dumb terminals. We have personal computers and personal computers got faster and more efficient.
I think I was 18 back then. You and I both would have been.
Yes. That whole age of improved efficiencies would allow us to be able to tax more down the road because there'd be more revenue.
Yeah.
So I'm not in the camp of this is doomsday. I am in the camp that if something doesn't change, then we are in trouble. But I feel like there's always a catalyst for change. And that's one thing that's great about America is that we can always work hard to solve problems despite the politicians. But I think as a individual person, what can you do? You can clean up your own balance sheet. It's important that you clean your own balance sheet up because even if the government screws up and the world changes, if you don't owe money, if you have a paid off house, if you have no credit cards, if you don't have a car loan, if you don't have business loans, all these things will allow you to be in a stronger position to maybe even take advantage of a bad situation as a business owner or even as an individual person.
Yeah.
So those are all things that most of us don't have, but these are things that we can strive toward over time. And then, some people get really worked over this. And I always say the same thing that I say to my teenage daughter, don't let anybody else steal your joy. So don't get so wrapped up in this that you get worked up and angry about it. But certainly make sure your own balance sheet is cleared up because unfortunately, you're not going to be able to control Congress. You definitely can't control a U.S. president, not this president. And you're not going to be able to control those around you, but you can control your own house and how you handle things. But I think that making really bad you could potentially make really bad decisions for yourself based off of this information, not understanding how it doesn't actually affect you as much as you think it does in the short term.
Yeah. Yeah. It's a great point.
Anything else to add?
No, I think that's great.
All right. Well, thanks for listening. And if you'd like to learn more about Wiser Wealth Management or speak to one of our financial advisors, you can do so by going to wiserinvestor.com or click on the show notes below. And we look forward to seeing you guys next week.
Thanks for listening to a Wiser Retirement podcast. We hope you enjoyed today's episode. Make sure to subscribe wherever you're listening. That way you don't miss any new episodes. We'd also appreciate if you could leave a rating and review. If you have any questions about anything that was discussed today, head to wiserinvestor.com and reach out. This podcast is strictly for informational purposes only and is not to be considered as investment advice or solicitation to buy or sell any financial products, securities, digital assets, or any other investment vehicles, or a basis to make any financial decisions. Wiser Wealth Management Incorporated is a registered investor advisor with the SEC. The host and/or guests may personally own securities, digital assets, or other investment vehicles mentioned on this podcast. Neither the host nor guests of the show are compensated for their participation, and no referral fees are paid to or received by any host or guest for clients, listeners, or similar interests. Investments involve risk, and unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor, tax professional, insurance professional, and/or legal professional before implementing any strategy discussed herein. Past performance is not indicative of future performance.